Hello viewers, welcome to my channel. Today we are going to see one illustration of study material, inventory valuation. So inventory valuation is also very important. Every time you get at least for 5 marks, one sum. This is also just like a bank reconciliation. Most of the time we are going to reconcile with the physical valuation of stock. Physical valuation means actual counting with what is recorded in the books of accounts. Okay. Now first let us see a very simple illustration. Why I took this, you should understand the basic concept of inventory valuation. Then only you'll be able to do some complex sums. Okay, now see here, we all of us know the formula for cost of goods sold. You all know very well from your class 11, cost of goods sold is equal to opening stock plus purchases. This is your net purchases. Purchases less purchase returns. Then all your direct expenses. You must be knowing the direct expenses. What are the expenses are directly related with the production and factory minus closing stock. This is what our formula. And we know from trading account also, I just make it in a rough way. See here, you are going to write opening stock here, then your purchases, that is I'm talking about net purchases, then your direct expenses, then what you do, here you write the sales. Sales, this will be along with the profit. Sales means with the profit. Then we are going to record the closing stock as per conservatism, either at cost price or net realizable value or market value, whichever is lower. So you know that. So the difference here will be the gross profit. If the sales and closing stock is more, you will get the gross profit. Now if you forget this, if you take this and subtract this, you will be getting the cost of goods sold. That is sales minus GP, you will be getting it. Okay, this basic fundamentals you already know. Now see here, I am going to write this formula itself, how to find out the closing stock. Okay, so now there is one more cost of goods sold is sales minus profit is again cost of the goods sold. Whatever the goods you sold, that is in selling price. And if you remove the profit portion, that is the cost of the goods sold. So then this is equal to opening stock plus net purchases plus direct expenses minus closing stock. Okay, now we need only closing stock. Here valuation is always about closing stock. So I am bringing it to the opposite side of your equals. So now when it comes here, it will become plus. So I am writing the formula here, opening stock plus net purchases plus direct expenses. Now this is going to that side minus, because this will be plus here, minus this I am writing as cost of goods sold, or you can write sales minus profit, either way. So now you understand what is the formula for cost closing stock, that is equal to opening stock. You need not to mug up all those things. Basically you understand the concept. Opening stock plus net purchases plus direct expenses minus cost of goods sold. Cost of goods sold here nothing but sales minus profit. Then this will become closing stock. We will be getting it at cost. Okay. Now let us proceed with the sum. So they have given, you have to write like this, calculation of value of inventory as on 31st March 2019. So I am writing here inventory as on inventory. This is your opening inventory on 1/4/19 is 1,42,500. Okay. So now the purchases we have to add. We have to add purchases. Purchases is 7,62,500. 7,62,500. I'll just rub it off and then this. I don't want the not there. Okay. So now this amount is 7,62,500. Okay. Now the manufacturing expenses is your direct expenses. I am writing in short manufacturing expenses 1,50,000. And selling and distribution, administration, financial charges, these will all appear in your P&L account. So that will not come into this. Now the total of this is 10,55,000. Okay. So now we have to reduce the cost of goods sold. So less cost of goods sold. Cost of goods sold is nothing but sales minus profit. Only the thing is that sales they have given 12 lakh. You have to make a working note for that. 12 lakh 45,000. To understand, I am writing here. At the time of valuing inventory on 31st March 19, now we are, I think this is for 2020. So this is for 2020. Okay. So at the time of valuing on 31st March 19, it is in the beginning, almost on 1/4/19. A sum of 17,500 was written off on a particular item which was originally purchased for 50,000. The item was for 50,000 and an amount of 17,500 was written off on 31st itself. So the item was valued at 32,500, 32, 7, 39, 40, 50. Yes, 32,500 on 1/4/19. On 1/4/19, this particular item was costing 32,500 and this was sold for 45,000. So it is a separate sale because we are not going to get the gross profit of 20% on all sales. So they are saying that barring this transaction, barring means leaving this transaction, other item we got the gross profit of 20%. So on this item we did not get 20%. So we have to remove this abnormal sale. We call it as abnormal sale. That is not in the normal sale. Normal sale fetched up around 20% of gross profit. So what is the normal sale? Normal sale is 12 lakh. Okay. So now see here, we need the cost of goods sold. So this 45,000 cost of this is, you can either way arrive straight away like this 32,500 or you can remove the profit portion. What is the profit portion? That was 32,500 which was sold for 45,000. So the book value was 32,500 sold for 42,500. So we can remove the profit portion as 12,500. So the profit was only 12,500 on this item. In these item, This was 20 percentage on sale. Straight away they have given 20% on sale. So that the profit portion is 2,40,000. So the cost of this is 9,60,000. So we need only cost. Here one cost is there, here one cost is there. So this is 12 lakh minus 20% of 12 lakh. That is 9,60,000, and the other item is 32,500. So the total cost of goods sold is 9,92,500. You can write here, give the working note 1. So you can give the name as working note 1 and make it neatly here. I'm just making it in a rough because to understand your this thing. So now the balancing figure is 62,500. This is the value of closing stock. Value of closing stock as on 31/3/20 was rupees this much. You have to give here working note 1. That is sales normal 12 lakh less 20 percentage GP, that is 2,40,000. So the cost comes to 9,60,000 cost. Okay. Next one item. This is abnormal sale 45,000. Profit on that is 12,500. So cost is equal to 32,500. You can write like this, or straight away you can take 12,45,000 sales minus profit. Sometime ICW will do like this, 2,52,500. That is the total profit earned. So 12,45,000 minus 2,52,500. Again you are going to get the same figure, 9,92,500. You can write like this also. 9,92,500. This is the cost. So you give the working note, and that's all. You have to understand the formula. Opening stock plus net purchases plus direct expenses minus cost of goods sold is your closing stock. This is cost price of closing stock. Whenever there is any issue on the sales, you bifurcate the sales into normal and abnormal, then take the percentage of sales, because borrowing this item means leaving this one, except this one. Others are sold at 20%. Hope you understand this problem. If you like my videos, please like and share, and don't forget to subscribe. Sorry, if you have not subscribed yet, and keep learning, and all the best for your upcoming exams. Thank you.